All that being said, of course, we always want to review our recently posted content. These last two over here on the right were actually from last week. A look at collar structures, expectancy, profit potential, and more. We reviewed the collar structure, the different forms of a long collar, buying stock, selling a call, buying a put against it, and reviewed the default criteria that's in the long collar search and why you would use and when you might use one of those structures over the other. We had a discussion on refining a bull put search and looking at the option chain, maybe to address which direction a stock is potentially going. That was from last week's. Now, this week we had 3 presentations and we did a 4th. We reviewed the default criteria on naked puts and bull put credit spreads. We discussed the idea of selling in the money cash secured puts against stocks that you already own to sort of help increase your shareholdings on the position but generate premium while you're doing it. Of course, last week, the market sentiment went to those sell warnings. It's eased off of that, but we reviewed what we look for with the market sentiment tool when the sell warnings pop up and more. And then something we posted yesterday, how to set up a historical search looking at weekly SPX bull put credit spreads. We ran a historical search over the last 2 months to see how those would have performed and compared it to basically how our weekly bull put credit spread default search would have done with the same allocation and criteria of that same time frame. This is the one I kind of chuckled about on the last slide when I mentioned that I may ask you for clarification on your question. This one was based on a great question that Brent sent in, but we sort of had a miscommunication on the question he asked. He had asked about a bull put credit spreads on SPX for weekly expirations with an 85 to 90 delta. And I showed the search, but we didn't get any results. And then it dawned on me later, that's not what he was asking. He was actually asking for an 85 to 90% probability or a delta on the short put in the bull put of negative 0.10 to negative 0.15. So we corrected the issue, put together the whole presentation on how to do that search and the historical aspects as well. But let's get into today's material, shall we? The quickies from email. Alice asked a question earlier today. I put on a position for Facebook on Monday. I sold the 300 cash secured put with a January 2022 expiration, got 554. Alice's question is, when would be a best time for me to consider rolling down? Should I roll down when it touches 300 before my expire date or wait until it reaches January expiration? Pierre had 2 questions. He has 100 shares of Microsoft, cost basis was 286. Sold a 290 call for next week's expiration. Stock has now jumped up to 335. Is there a way to minimize the loss only on the call? Trade would still be profitable. Or is it better to let it be assigned? And last but not least, for Pierre, how can I minimize the margin requirement? So if he wants to get back into Microsoft, selling maybe a 290 or 300 strike put for December expiration or maybe closer in time, is there a way to minimize the dollar amount needed in that case? All right, well, let's go ahead and pause the screen. We are going to navigate over to PowerOptions, and we're going to walk through these 3 basic questions, not basic questions at all, they're great questions, don't get me wrong, but we're going to walk through these and sort of discuss what I would look for. Now, we're going to go into the portfolio tool. I've prepared the positions here in our portfolio for November 12th. And we're going to take Alice's question first. And Alice's question was, of course, related to that short put on Facebook. Sold the 300 put on or around November 8th. We got a 545 premium for it. I only used 1 contract to keep the math simple. The position has moved up now to 340. It's been increasing in price, up 13.15 today, a pretty good move. So she's got almost $100 profit on this position. But Alice's question was, when should she consider rolling down? She wants to hold it to January for the max profit if possible. But when should she consider setting a stop on the position or consider rolling down if Facebook starts to pull back? Our general approach for cash secured naked puts, bull put credit spreads, possibly even out of the money covered calls, if you're just hoping to sell out of the money covered calls, have them expire worthless, and just continue that pattern, trying to collect a dividend-like income on a monthly basis. Our general approach would be the 1% rule. This position is now almost about 11% out of the money. When Alice sent the email, it was about 10% out of the money. Stock was around 330. She had sold the 300 put right here where the elbow is on our profit and loss chart. Max profit, of course, is 545 if it expires worthless in January. So we're 10% out of the money. When would I consider the potential that the stock is moving against me? Well, naturally, when I start to see changes in the trend. What do I mean by changes in the trend? Well, if I opened this position, it was likely because I was bullish on Facebook. I likely would have opened a covered call or cash secured put because I feel the stock is potentially moving up in price, has above the 20-day moving average, maybe has a positive MACD and a relatively good looking RSI at this time. When the stock starts to pull back, whether it's because those fundamentals are changing, or whether it's because something else in the market, as it starts to move down, as it starts to get within that 1% of my short put strike price, in this case 303, that's when I'm going to consider rolling down the position. I started out 10% out of the money. If it gets within 1% of that short put strike price over the next, was it 55, 60 days to January expiration, a little bit more actually, that means it's dropped 9% during that time period. It's not going in the direction that I want for this neutral to bullish strategy. So that's a general approach that we'll consider, is that 1% rule. 1% of my short put strike price. So if the stock hits 303, 1% of the 300 put strike price, that's when I'd consider evaluating rollout opportunities or adjustments. And of course, to help us with that approach, whether it's a bull put credit spread or whether it's a naked put position, as we're tracking the positions in the portfolio, we'll go into the alerts column, we'll click on view, and I'll set the alerts for each of my individual positions. And what I want here is I want the upper limit, I want the lower limit at 303. So that's my 1% of my 300 put strike price. I'll set the alert there. And of course, I might even tell you, hey, if the stock changes direction and now starts trading below the SMA 20, or if I'm within a few days until earnings, I want to be notified of this. It's a longer term position, a few months out, maybe a leap position. I want to be notified about that as well, so I can prepare or maybe adjust the position. So we'll set our triggers there. And once I've set that, it's going to notify me here. It fills it into the lower stop limit of where I might look to consider rolling or adjusting the position. And as always, if a trigger is hit on one of the positions I'm tracking in my portfolio, we'll go to position actions and position analysis to evaluate rollout opportunities and adjustments, where we do all the math for you in that case. And you can see the new potential, in this case, naked yield and probability for rolling down the position, rolling for a credit, or rolling for a debit. Before I move on to Pierre's question, Stuart says, does this affect delta or anything the further out you go? Oh, okay, Stuart. So when we get to Anthony's question, which is after Pierre's, Stuart, I'm going to get your question on leaps, okay? And we'll take that in just a moment as well. All right, so let's move on to Pierre now. Remember, Pierre's first question, of course, was related to the Microsoft 100 shares stock. He had a call spaces of 286, sold the November 290 call, November 19th, for 925. Stock is now gapped up to 336.72, and he originally expected 4.8% on the maximum return on this covered call position. Right now, he's at 80 to 90% of what he expected to make on this transaction. That's usually a position where I might consider closing early if I can, if the goal was to be assigned and I wasn't interested in holding this further. Let's take a look at that profit and loss chart for Microsoft, as before. And there we go. There's our 4.8% return. We're pretty much just at intrinsic value with our 290 call. What is Anthony losing on this? I'm sorry, not Anthony. Is Pierre losing on this position? Absolutely not. It's still a profit. The call is showing a significant loss because it went from 925 up to 46.83. If he looks to buy it back, that's true. but on the overall position, you're still profiting. We've covered a lot of content recently on this topic. Let me just go to YouTube real quick and open that up full screen. The one I mentioned to him via email is how to repair a covered call when the stock gaps up. This example was LCID. And there's some other ones that we covered recently about rolling. Can I use the stock repair? Oh, that's for a bought call, excuse me. But yeah, there's some other ones here. If you just look up rolling a call, rolling a covered call, you'll see a lot of recent discussions on that topic as well. But this is the most recent one on LCID when the stock gaps up in price. Now, you can roll the position, but at this point, I've got into the position. I committed myself to the covered call structure, knowing that if there was a large gap up in price, that I'm going to have this flatline gain. To be honest with you, when you commit to the covered call, there's no magic we can do right now to take advantage of this missing 40 points because our option has gone to intrinsic value. Our option is at the same 40-point difference that we have there. So now there's nothing that we can do directly. Can I increase my return? Absolutely. As I mentioned for Alice's question, if my alert is triggered, I'll use the position analysis to evaluate rollout opportunities. The same thing here. We'll go to position actions. We'll click on position analysis. This gives us a breakdown of our current Microsoft position in this case. We know where we stand. Current liquidation value is 4.7%, 99.2% of what we expected to make on the entire trade, which is the 4.8% which we can realize in 7 days. So we're at 4.8% max. As I look at some of these opportunities of rolling to the 17th of December, I can increase that return from 4.8% up to 6.4%, so 1.6% increase, potentially up to 7.1%. That's not too bad, right? It's a 2.3% increase for an additional 35 days out in time, really 28 if I hold it for the next 7 days. But what is the problem? The problem is all of these rolls are going to have to be done at a debit. I'm paying $46 to buy to close this call. Selling the new call here at $6, yes, it's at a higher strike. I could get assigned at $3.40, which is what increases the return. What I'm also doing is increasing my cost basis by $31.58. So now, if Microsoft does pull back in this case, we could have more of a monetary loss in the position because we have a much higher cost basis. Can I roll potentially for a credit? Well, let's see. We got to scroll all the way down. In this case, and even sticking almost with the same strike. Oh, there they are. Yeah. So I can get credits rolling to the 300 call, which is still deep in the money. Roll for a credit at the 295 call, credit of 825. That's my adjusted net credit here. But that's for 98 days out in time. And I'm only increasing the return from 4.8 to 6.2. Another 1.4% for 98 days. That probably does not match my trading plan. That's 3 months, a total increase of 1.4%. So what are we talking about? We're talking about 4.44%. I'm sorry, 0.44% every 30 days. My target's probably going to be 1.5 to 2%, not 0.44. Okay, so sometimes it's okay to roll for a debit. Other times, if you don't want to increase the cost basis, you may just want to take assignment. That was sort of Pierre's question. Should I roll the call as well? Should I consider rolling the call? And you have some opportunities here to increase potential return, although you have to increase the debit to do it. Or should I take assignment in 7 days and then buy back in the stock? You are so close to intrinsic value right now. There's only 0.1% of time value remaining in this option. It's actually registering a 0% time premium with a 1 delta on your sold call, Pierre, which means what? There's no real mathematical difference between getting assigned in 7 days. Okay, assuming the stock stays around the same price. It can fluctuate too, but as deep in the money as your 290 call is, there's really no monetary difference between getting assigned, and then buying back Microsoft at 336 and selling, say, the 340 call, versus buying back the call now at almost 100% intrinsic value. There's literally no time value left on this position, and rolling to the 340 call. Mathematically, it's the same. You could evaluate what your cost would be to your broker, and you would pay less of a cost for rolling the call versus allowing assignment and then buying back the stock and then selling another call. Likely to roll it is going to be cheaper, but you're so close to intrinsic value right now that that's where we're looking at. I don't know the exact date. He said a month ago when he sold the 290 call for 925. And that other webinar I referenced that we did a week ago about alternatives that you could do beforehand, in this case, is that when Pierre sold the 290 call for 925, he may have been able to buy, let me just see a look here, a couple strikes out of the money. Okay, well, he might have been able to buy the 305 call. Yes, 15 points out of the money. We could look at the historical chain, but I don't, again, know the exact date. But let's say I could buy this 305 call for maybe $4, maybe $3.50. Let's just call it $4. It's further out of the money. Buy it for $4 at the time. So now instead of taking in $9.25, we're only going to take in $5.25. What's the benefit of doing this? The benefit of doing this is you leave the upside open for more potential profit. Yes, there's this little sort of gap and this little sort of hiccup here and flat line in the middle, and that 15-point strike difference. But if you have a stock that runs, this concept, what we teach is income method number 6 in the blueprint, which discusses the married puts, can enhance the profits on a runaway stock as opposed to just selling a covered call in that position. Am I still risking being assigned at 290? Yes, but now I have the right to buy the stock at 305 if there's a large run. I leave the upside open for more potential profit. That is a consideration, but you will be lowering the initial premium that you took in. It is an alternative that can be used to covered calls. And this is something that I would consider in the situation that Pierre was in. And what I mean by that is, let's go back to the stock research tool. This just shows us some of the basic information for the stock. And let's go back to October 22nd or so, a few days before this run that he was talking about. What was the reason for the run? Microsoft had earnings after 10/26. I might not necessarily want to be in a position that has a capped gain going through earnings, especially if I'm bullish on it long term. A structure, not that one. A structure such as this, with that extra long call that, yes, took away from the premium, took away from some of the downside protection to pay for it, that might help me longer term in these scenarios. I don't like to leave a capped gain open in my positions as I'm heading into earnings. So this is an idea, Pierre, that could help you. On that note, second part of Pierre's question related to the naked put positions as well. Now that this has happened, he's considering should he get assigned or should he roll. He's thinking about getting into another position and selling maybe a 290 put against Microsoft to try to get back into the stock if it pulls back. In the portfolio here, I entered the 325 put for December 17th. And the reason why is that Pierre probably has a price point that he likes around 290 or 300 if he's planning on getting back into it. But when I looked at the option chain for our put positions, let me go to a medium chain very quickly. That 290 put at 80 cents is only a 0.3% naked yield. If I'm going 25, 30 days out in time, as I mentioned, I want to try to look at least for a 1, maybe a 1.5% return, which is putting me at the 325, 330 strike put. Microsoft is lower volatility. We're not as deep out of the money, but I'm still getting at least a 1% yield for 25, 30, 35 days of trading. That's why I use the 325. But the question that comes up is, what is a reasonable way to help limit the massive monetary requirement with stock at this price or potentially in the case of Alice's put option at the 300 strike for Facebook, how can I reduce the margin? The best answer for me is really a bull put credit spread. But do a wider spread. What would I have to do? I'm going to have to put up $32,500 for one contract to sell the 325 put to be totally cash secured in this scenario. Now, I collected $4 premium. That gives me sort of that 1% view that we were looking at, 1.2, 1.3% view. I go to the same expiration. I don't want to get involved with a calendar format here as well. And yeah, so we collected $4. I want probably maybe less than a quarter of that. I might consider the 295, maybe even down to the 290 that you were considering. So I'm only putting about 80 cents into the position, still making 320 of profit, which is still right around 1%. But now, with the 290 put in place, am I going to lower the premium? Yes. But instead of having $32,500 for one contract with margin requirement, now I have $3,500. I just have to cover the difference in the strikes. I'm about 1/10 of the margin requirement for this position. I'm in a bull put credit spread. If the stock falls below now 325, goes to 320, I can still be obligated to buy shares of stock and need that 32,500. That is absolutely true. But in this case, in the trade, I only have to put up 3,500. I'm not getting the 400. We're only getting about 320 now, but we're still close to 1% against the underlying stock price at 336. You could buy a lower put, go up to a $4,000 margin requirement, a $5,000 margin requirement, and keep a little bit more premium to be closer to 1%, Pierre. But this, in my opinion, is the best way to lower the risk of a cash secured naked put while still potentially being able to get in the stock at a discount if it falls below the strike prices. And we're putting up 1/10, 1/8, 1/5 of the cost that we would have to put in, depending on the strike difference that you select in those scenarios. All right, so very quickly, before we get to our next questions from Stuart and Anthony, quick review here for Alice. In general, we use the 1% stop rule. We'll look to roll prior to expiration if the stock reaches near the short put strike price. In your example, selling the 300 put, I'd set the alert at 303 in the portfolio to alert me. For Pierre, as discussed in recent webinars on the in-the-money covered calls when a stock suddenly gaps, we've seen examples recently of Lucid, Chemotrex, I can't remember. We had a couple of discussions of those back in September when that stock really took off, CCIX, I believe. When the gaps happen, there's not much to be done. You've already committed to the covered call structure. You can still roll for a higher profit, but that's usually going to be at a higher cost, as we saw. If you try to roll for a credit, you might be going 5 months or 6 months out in time. That might be okay if that matches your trading plan, but you have to consider what can happen with the underlying stock with that 5 or 6 months period. The alternative, consider buying an out-of-the-money call against your covered call, especially going into things such as earnings or known events. If there's an FDA approval, pending patent lawsuits, something that might cause the stock to gap up, that leaves your upside open. Are you going to make the full amount? No. You're still going to have that difference in the strike prices where you're going to have that flat line we saw on the graph. But if it does take off beyond your expectations, you have left the upside open. That's one of the 12 income methods we use in the married put structure discussed in the blueprint, can also be converted to covered calls in these situations. Minimizing the margin requirement of some of these high price stocks we're talking about, Facebook at 330, Microsoft at 336, we're selling a 300 or 290 put. Best approach, buy a cheap out of the money put, maybe 20 points apart, 25 on these higher price stocks, 30, 35, 40. That reduces the margin requirement, but remember, you may still be obligated to buy shares of stock at your short put strike price. If the stock falls below it, not below both strike prices, but if it's between the two strike prices, you still might need that $32,500 to buy those shares of stock at that put strike price. So you've got to consider that.